Hello everyone, welcome to Ayurveda Learning Hub. So, I hope you liked all our videos, you have liked the entire IPO playlist, as I have been telling you more about IPO, and in today's video, I'll tell you more about non-funding goals, Companies Act and everything. So, do hit the like button for this video, and if you have any doubts, tell me in the comment section. Subscribe our channel, turn on the notifications, keep following. So now, there are various fundraising options, like for investors, obviously. So as an investor, you can buy stocks, IPO. So majorly the market is divided into two things. One is called debt and one is called equity. Debt is DEBT, debt, not debt. Okay, so debt and equity. Third one can be hybrid, which can be investing some amount in equity and some amount in debt. So debt has debentures, bonds, banks, FDs, everything. Now equity has IPOs, FPOs, shares, those things. So debt option is there and equity option is there. So for both of them, you can choose your investments, you can invest widely. There are abroad options also, but we will majorly focus on Indian options. Abroad we have ECBs, ADRs, GDRs, but let's focus on Indian ones. So as we were going through the IPO process, now we will know what are the non-funding requirements of a company for which it releases an IPO. So retention and initiative for the employees through stock options. So sometimes it is there in certain companies, like Reliance did it once, I remember. Reliance was like, okay, every employee of mine right now will get this many shares of my company. So that's a great offer, right? Sometime later the share price will grow and it will cost you a good amount. So sometimes to attract the employees, when you can't pay salary on time, so even if you are paying, you are losing out on employees, people are moving out, you put out shares for employees to attract them. Now, liquidity to shareholders. As we discussed this earlier also, that angel investors and earlier shareholders sometimes need liquidity. Some from my family helped me, but now that person wishes to move out. So I'll get some liquidity, I'll release my IPO, I'll get more money, and then that person can move out. Now, diversification of global funding. So when I wish to expand my company throughout the globe, I can't raise that much money from my friends and family. So I need to ask for funding throughout the world. So that is why we mostly release IPOs. Now we'll learn about the Companies Act 1956, which has been released by the government with the consideration of SEBI to decide how to go through the IPO listing process. So the Companies Act 1956 has provisions related to prospectus. Now very soon I'll describe you what is prospectus, but for now you need to learn it, like it's a very important document for IPO listing. It's supposedly the most important document. You read it very thoroughly when you are buying an IPO. So now it has provisions on subscription, allotment, returns for the allotment, what returns you will be getting, how to subscribe, how much to subscribe, how will it be allotted. It has everything. This is all included in the prospectus and it's a very important document. So the power has been given to SEBI under section 55A of the Companies Act 1956 related to the issue and transfer of securities. So this is a sort of security. IPO is also a security. So the power, SEBI has the power of how will be the securities listed, how will be they go on, how will be they, like everything goes on. So this comes under Securities Contract Act 1956. Now SEBI's full form I like to mention, Securities and Exchange Board of India, and it takes care of everything. It's like a policeman taking care of law and order throughout the IPO process. It does it for the company, for bank, everyone, and it takes out if there's no malpractices going on against the consumer, against the investor and everyone. So SEBI is like a policeman in this process as per the Companies Act 1956. Now, as I said, I'll be describing what is prospectus and how to analyze the prospectus. So how to analyze the prospectus summary? So first let's go through what is prospectus summary. Now it briefly summarizes information which is disclosed in great detail throughout the prospectus, including company's business strategy. So as we said, the future plans. You will invest in a company which has good future plans, which aims to expand in Europe, in Africa, in America and everywhere. So you won't invest in a company which usually you don't choose to invest in rural companies. Mostly if you are a retail investor, if you are a big one, you may choose to invest in anything. But retail investors prefer investing in companies which are sure to make profit. So you won't be investing in such companies which are rural based? Yes. So what are the future strategies, business strategies? What are the plans for using the funds? Now, how will the company use your funds? Will it use it to repay the loans? Will it use it for further expansion or whatever, or for the help in exit of investors? Company will be describing that in the prospectus, and you will be reading it to choose how is your money going to be used. Now supposedly a company is in financial condition, it's about to go down and it releases an IPO. So retail investors don't buy such IPOs because your money might lapse. HNIs buy because they have huge amounts of money, they can do, QIIs do it. So carefully read the prospectus, analyze the risk factors, how will be your proceeds used, analyze everything, what is the dividend policy, etc. Go through it, find out, and then invest in a particular IPO. So now the market in which an IPO is listed is a very important market, obviously, and it's called the primary market or the new issues market. Now this primary market is where a company or an institution raise funds or capitals from public by issuing new securities. I hope you noted down the definition of primary market. Let me repeat it for you. New issues market, where company or institution raise funds or capital from public by issuing new securities. It's very clear, very evident. New securities are issued, new stocks are issued, new IPOs are issued, initial public offerings are issued to gain from public, to gain investments, capitals from public. Objective is very simple, to raise capital. There is only one objective, to raise capital. No matter how will be the capital used, no matter why is the capital needed, one objective, to raise capital. Now, there are two major companies or entities which issue these IPOs. Now, the IPOs are issued by corporate entities or the government entities. So, like I gave you an example in the previous video, IRCTC, it is a government entity, it releases an IPO, it can release an IPO, it obviously can. So, it's a government entity, releases an IPO. Reliance, Tata, your LNJ, L&T, then Sun Pharma, these are private entities releasing an IPO. So major types of issues are there. Various issues can be like IPO is initial public issue or initial public offering. There are other types of issues too, public issues, preferential issues, rights issues, bonus issues. There are things you need not know about them right now, but in one of the videos, if you want to know about them, tell me in the comment section, I'll describe it for you. So keep following. When we move on to the next video, we'll classify the market into primary and secondary. I'll define it for you, I'll give you the examples. Do hit the like button for this video, and if you want me to describe these public issues, preferential issues, tell me in the comment section, I'll describe them for you. Subscribe to our channel, the AccuWeather Learning Hub. Follow me up for the next video.